Warren Buffett once said you only find out who is swimming naked when the tide goes out. This is what the investing guru meant when he said that real investors only succeed when the economy is weak. When the economy is strong, it is easy to disregard all caution. During this period, virtually all investment options perform well, and investors receive favorable returns. In times of economic turmoil, investors realize the importance of adhering to the fundamentals of investing. These principles are extremely vital, but only a select few elite are aware of them. And there has never been a better time than now to learn how to invest. Several sectors of the economy have been declining as a result of the pandemic's aftermath and uncertainty due to a potential global war. Yet some wealthy individuals have made more money than ever. How did they accomplish it? We're going to share 10 principles that will have you investing like a millionaire. However, before we begin, please like and subscribe to this video. If you're new, let's get started. Number 15. Have a personal financial roadmap. The very first rule is to fully comprehend your financial situation. If you have never created a financial plan before, it is especially important that you evaluate your current financial situation, determine your risk tolerance, and establish your goals. Whether you are working with a professional or on your own, this is the initial step you must take. Honesty is a crucial consideration that must always be kept in mind throughout this process. As cliché as it may sound, you must be as open as possible. The truth is that it's not guaranteed that you'll recoup your investment, but if your roadmap is well written, chances are you will. Number 14. Invest early. It has been demonstrated that investing early is more effective than waiting until you have a large sum of money to invest. Begin with what you have and build your portfolio gradually. Investing and purchasing early will allow you to take advantage of the power of compounding. In case you were unaware, compounding is simply using the money you've earned to earn more. Therefore, you will not only profit from your initial investment, but also from the capital gains interest on dividends you've accumulated. A 2-year difference in investing could result in the potential loss of thousands of dollars. Number 13. Diversification. The majority of wealth managers and successful investors have mastered the art of diversification. Never place all of your eggs in one basket is sound advice. While this may appear to be common sense, you will be surprised at how uncommon common sense is in the world of investing. Diversification is surprisingly simple. It entails selecting multiple investments as opposed to a single one. By diversifying, you reduce risk. Consider this scenario. If you invest in a single company, that company will fail. Depending on your share type, you may lose a substantial amount of money. Ensure that, as you diversify, you choose a broad range of investments. Different asset categories have never risen and fallen at the same time throughout history. This means that when stocks decline, there is a chance that bonds are still rising or have fallen, but never at the same rate. However, having a portfolio guarantees that your losses will be limited. Number 12. Leverage is key in building wealth. Utilize leverage to amass significant wealth. You are only limited by what you have. So if you want to amass enormous wealth, you will need to seek leverage. Multiple forms of leverage are available. Leverage is the use of other people's funds to increase the pool of available capital for wealth creation. Since you only have 24 hours in a day, time leverage is the use of other people's available time. In actuality, however, there are only about 16 of you, as the rest of you are probably asleep. Leveraging knowledge is the utilization of other people's expertise. Because you do not know everything, someone else is more knowledgeable about investing than you are. Leverage refers to the utilization of other people's established, more effective and efficient systems. Number 11. Be vigilant of fraud. There are con artists everywhere, and they are always searching for their next victim. Avoid being one. Typically, these fraudsters use highly publicized news stories to attract investors. The opportunity they offer is frequently too good to be true. Before investing, ask as many questions as possible and request official documents and consult a lawyer to evaluate the entity's legitimacy. Number 10. Cash is the king. If anything, the pandemic has emphasized the importance of having a cash reserve before developing a financial plan. The reserve should be between 3 to 6 months' worth of expenses. Start by listing out your expenses in numerical order. so that you are aware of exactly how much you spend each month. People who had reserves when the pandemic first struck were likely less affected by the economic turmoil. Their reserves allowed them to sail through the turbulent waters unscathed. We have control over our emergency funds, but not over economic fluctuations. Ensure that the cash is stored in a secure location in the event of an unforeseen event. Number 9. Deadly debt. Advisors note that debt is both beneficial and detrimental. It has both advantages and disadvantages. Debt is beneficial when the funds are used for investments and not to cover expenses. In fact, the majority of wealthy people increase their wealth through debt. But the reality is that those in the best financial condition are debt-free, and even sophisticated investors and businessmen can run into trouble if their debt loads are not closely monitored. By incurring debt, you are obligated to continually make the repayments according to the agreements and ensure you meet all deadlines. However, anything can occur, which could compromise your ability to make the repayments on time. We are not completely opposed to debt if it is necessary, but only for investment purposes and never for personal expenses. Also, if you must incur debt, create a plan to eliminate it as soon as possible. It is not always certain that your income streams can support loan payments. War between Russia and Ukraine is a prime example of a situation in which debtors are still obligated to make their payments, regardless of the circumstances. Despite the majority losing their jobs and migrating to other regions, they must still repay their loans. Number 8. Time frame is key. Before constructing a portfolio of investments, it is vital to comprehend your time horizon. By understanding this, you can keep volatile market conditions in proper perspective. A long-term investor, for instance, does not fear bear markets. In fact, it provides a fantastic opportunity to trade at discounted prices and earn excellent returns after a specified time period. Consider how knowing your time constraints can aid you in developing a solid investment strategy. It is extremely irresponsible to build a portfolio without knowing when the money will be needed. Number 7. Dollar cost averaging. This refers to the periodic addition of cash to investments at predetermined intervals. This could be once per week or once per month, depending on your ability. Some individuals are emotionally invested in sports, others in politics, the environment, etc. Therefore, it is reasonable to be emotionally invested. However, the reality is that emotionally driven investment decisions almost never succeed. However, by implementing an automated investment plan into your accounts, the entire process is devoid of emotion. It reduces the desire to time the market and enables the gradual accumulation of wealth over time. Number 6. Rebalance to make money. Rebalancing is founded on the principle of buying low and selling high. It involves adjusting the asset weights within a portfolio to capitalize on the changes. This strategy allows you to simultaneously sell positions whose value has increased and those whose value has decreased. This allows the original asset allocation to remain consistent with the risk tolerance of the portfolio owner. Number 5. Conservative bonds are a safe haven. When markets are soaring, many investors disregard high-quality fixed-income investments. There's nothing wrong with the fact that everyone is rushing to buy the rapidly appreciating technology stocks. The reality, however, is that when the market is performing exceptionally well, turbulence typically ensues. Yes, you will experience some returns, but for how long before a decline? Here, bonds come into play. Bonds are a crucial component of investment portfolios. Bonds provide a buffer for volatile markets by allowing investors to withdraw from an asset whose value did not decline. To disregard bonds as a core investment strategy is short-sighted. Number 4. Returns and risk go hand in hand. Every investor out there is diligently seeking the option with the highest return and lowest risk. Finding a balance is difficult, as the higher the promised return, the greater the risk of investment loss. There are numerous potential sources of risk, including illiquidity, poor credit, and leverage. Illiquidity is the inability to quickly convert an asset into cash. Additionally, economic conditions are extremely volatile and play a crucial role in determining the rate of return. As a result, investors should always maintain vigilance. Every lucrative opportunity entails substantial risk. Number 3. Boring always beats exciting. Humans enjoy exciting experiences. They favor the next best product on the market. However, there is a thin line between an exciting opportunity and a viable opportunity, which the vast majority of individuals fail to recognize. Most investors mistake an exciting idea for a viable investment opportunity. This excitement is frequently packaged as the latest fad, a new business model that will revolutionize the way business is conducted, the newest technology, or an exclusive deal. Instead of focusing on fundamentals, most individuals concentrate on the hype. Remember what was stated earlier regarding the use of emotion in investment decisions. I hope you now have a better grasp of the point. To avoid being enticed as a child would be by candy, stick to boring conventional investments. This may include index funds, blue chip stocks, or even investment-grade bonds. You may miss out on the next hot initial public offering, but you will not miss out on stable returns. Number 2. Keep an eye on fees and taxes. Brokers charge commissions on every trade. The average percentage and transaction fee for each seller is between 2 and 5%. Commissions vary between brokers. Also, taxes on capital gains can reduce your overall returns, so evaluate the regulations in your jurisdiction to determine what taxes are due on your gains prior to making any investment decisions. Number 1. Move on from the stock markets once you win. The stock market is habit-forming. Numerous individuals compare it to gambling. Once you earn a substantial amount of money, you will always desire more. To avoid severe market downturns and the stress associated with waiting out bear markets, it is prudent to exit the stock market once you have accumulated a substantial profit. You can always seek alternative investment opportunities with stable returns, even if they are not as lucrative as the stock market. We appreciate your watching. If you're still around, I'm sure you've appreciated the video.